Hello and welcome. I'm Austin Root, Chief Investment Officer at Stansberry Asset Management. And on behalf of all of us at SAM, thank you for joining. With me today is Deputy Chief Investment Officer Michael Joseph. Michael, thank you as well for coming.
It's my pleasure. Glad to be here.
Yeah, no, this is great. We have a fantastic opportunity to talk with folks about kind of what we've seen over the first half of the year, how we're positioning portfolios and investments for the balance of the year, kind of what we think people should own right now and really on into the future. I think we're going to be make great use of our clients and future clients' time.
Absolutely. We're not even halfway through the year yet, and it's been a lot going on. So we have plenty to talk about.
Yeah, tons going on, tons to talk about. So what do you say we get started?
Let's get to it.
All right. So title of today's presentation is The Right Investments Now. Own what matters when it matters for you. And, we'll get into it a little bit later, but that, one of our favorite strategies among our strategies is really that's when you and I, we created that strategy. It was sort of like owning the right things at the right time. And that's easier said than done, but look, we'll do our best to get through this and sort of give you our perspective. And really, as we talk about this mid-year focus or kind of looking out for the next balance of the year, it's really with an eye to be prepared and focused on long-term growth, not just 6 months. We, of course, want to perform well in any month or quarter or even year. But as you and I know, the real focus is long-term compounding. Are you meeting your goals? Are you hitting those long-term objectives, not necessarily the 1 week, 1 month, or even 1 year?
Absolutely. It's critical to not miss the key moments and the changes in the short term, but part of the trick is not falling into the all the noise that's out there and losing focus on the long term.
That's right. As we were preparing for this presentation, really over the last month, as we're working and managing the portfolios, we had a client ask us a question that we both thought was very thought-provoking. It was noteworthy in part not due to the question itself, but actually who was asking it. A client who may, in fact, be on this call is a senior executive at one of the largest AI and technology companies in the world. And it was interesting to us, in part because of the topic, but also because this person who's in the nexus of the universe as it relates to AI and innovation is really asking the same questions that all of us are asking right now. And that specifically was, even though I don't fully buy into the doom and gloom extremes, it's hard to know what exactly to expect in this market with AI, high debt loads, and other concerns. And so the question is, how do we protect capital from a massive drawdown while at the same time avoid being out of the market if and when the market has a rapid rebound like it's done many times in the recent years? So super thought-provoking. And Michael, we thought we would start with this question because I think it's a great way to sort of form how we're thinking about the rest of the year. It's also the basis of Stansberry Asset Management itself. Growing and protecting your capital is why Stansberry Asset Management was created. And that was, so for those that are newer to our family or our future clients on this call, we started Stan about 10 years ago. We've grown from kind of one investment strategy to 10, from $0 to more than 1.3 billion in assets. We're across many different parts of the country. In terms of our official locations, we've got offices in 4 spots, but we've got people in many different spots beyond that. We started investing on behalf of individuals. We've branched out to really focusing more on families, but we also do some institution and business investing. And we also started kind of only as an investment manager. And we felt like for many folks, while they need a competent investment manager, what they really need is a wealth manager, someone that's helping them not only invest their capital, but making sure that that capital is invested the right way for their family with a holistic financial plan and the like. And so I'm really proud of that growth in our abilities. Of course, like we said, we've grown our assets and proud of that as well. Not so much because we've grown, but because we've protected folks' capital even during tough periods of 2020, 2022, where actually most of in 2020, in both of those periods, many firms lost assets. We did not, and actually grew our asset base given the outperformance we afforded clients. As recently as 2025, we did the same thing where tough period of the market and really try to protect people's capital. We could talk maybe a little more about this back and forth later, Michael, but we both kind of recognize how important it is to avoid large losses in a portfolio. So with that, let's go into that. I think for our conversation today, you'll provide a little bit of a backdrop. We'll talk about, should we be invested? Should we stay invested given a backdrop? You're usually an optimistic guy, Michael, but part of your backdrop is not that optimistic in terms of the many different cross currents going on in the market today. We want to talk about how we're doing that, how we recommend many other folks do that. In the context, one of the most pervasive parts of change and market moving aspects of the world right now is AI, and so we'll talk about how we're investing in that, and then we'll bring it all back home and kind of wrap up and sort of talk about what's most important. Does that sound like a good use of time there?
I love that. I think we cover a lot of bases there. And yeah, to your point, I kind of drew the dreary card here and kind of started off with a backdrop that, has some concerning elements to it. And, I can promise you that the whole of this webinar will not be super doom and gloom. But at the same time, I think we'd frankly be putting our heads in the sand to not acknowledge that there are some areas of concern out there, and not only acknowledging them, but frankly understanding them, and where it's appropriate, working those into our outlook and the way that we're approaching this market, I think is a critical thing. So let's touch on some of those.
Great.
I think that's probably first and foremost in a lot of folks' minds is of course the Iran conflict, and this has been an interesting one. In a lot of ways, but certainly one is that we have a long history of seeing these regional conflicts flare up, and we know that historically they tend to really not have a lasting impact on the global economy and global markets. But this has been an interesting one in that Iran's stranglehold on the Strait of Hormuz has really demonstrated how a country can really cause a lot of impact from taking advantage of an economic choke point. And so we're kind of witnessing that in real time. A lot of folks, of course, realize that a lot of oil goes through there, but there's frankly a lot of commodities that pass through the area, petrochemicals to be sure, commodities that are used in agriculture and production of plastics, just touch on so many industries beyond what we, immediately associate, like the price at the pumps. So this is a critical passageway, of course, and the ramifications are really global in nature. The next slide shows from a commodity standpoint, right up until the military escalation, how much of global supply was passing through the strait for various commodities. And these energy and petrochemical commodities are frankly building blocks for modern civilization. They're essential in so many areas. This is kind of a high level view on some of these. If you double clicked into some of them, some are more impacted than others. But in the chemical bucket, for example, it comes to my mind as an example of just kind of an odd one that you wouldn't necessarily think of immediately, but 30% of global helium passes through the strait. And Austin, your kids are a little more grown than mine, but I'm still of the era that in normal times, I think of helium as like, inflating some party balloons for them. But helium's actually used to launch rockets and for MRI machines and semiconductor manufacturing and all sorts of critical areas that we don't immediately associate with. So potential for disruption is quite high here. Because of that, we've seen estimates for GDP across the globe become more modest. We're still projecting growth, but just less of a growth trajectory than we've been at for a lot of areas. Rather than clicking into all these areas, I would just highlight that countries that are energy importers, particularly Japan and a lot of countries in the Euro area, we think are particularly exposed to headwinds the longer the bottleneck holds in the strait. Also coming with that is a spike in inflation, and we've already seen this start to trickle into the numbers from the beginning of the conflict. And this is no surprise to anybody that's, in the last month purchased groceries or bought some gasoline or God forbid, diesel fuel. Prices are going up quite a bit. And, inflation is notoriously difficult to predict, but I think it's reasonable to assume that the longer that bottleneck lasts, and the more we deplete through existing inventories, the potential to see increased inflation is certainly there. If you joined us for webinars in the past, you've probably heard us talk about this idea of a K-shaped economy before. It's simply inferring that folks that are higher income or asset owners, they're experiencing a different sort of economy than the ones that folks that maybe are lower income or not owning a lot of assets are experiencing. And we're showing that on this chart by use of two data sets. One is the S&P 500, which is that green line going up. The other, the blue line, is the consumer sentiment survey from the University of Michigan, which not only has it not recovered from its pre-pandemic levels, pandemic being that sort of a gray bar going up and down around 2020 there, but just a few days ago, it actually hit an all-time low. So consumers are incredibly dour. Part of that is the inflation that we just talked about. At the same time, markets are close to all-time highs. So certainly it hasn't been the case yet that dour consumer sentiment has derailed the bull market, but it's certainly an open question. And we're hearing more and more companies talk about how pressured consumers are. Inflation certainly is a factor there as well. One company that I think has their fingers on the pulse of this quite well is McDonald's. And we heard from them on their most recent earnings call, just calling it out bluntly, like elevated gas prices are a huge factor for lower income folks. They are impacted by it disproportionately. More of their income as a percentage goes into filling up the gas tanks. So when we see these big spikes, it hurts them, and that translates into less spending. Interestingly, they also called out that higher income consumers not only have shown resiliency, but they're actually gaining more market share at McDonald's with higher income folks. So I suppose you could take that a few ways. If you're a glass half full kind of person, you could say, well, higher earners are showing resilience, but you might also be a little concerned that folks that are earning more income are opting to not go to the steakhouse or the sit-down restaurant, but are increasing their frequency to visiting McDonald's. So something we're watching to be sure, and I think it's
not to disparage the Big Mac, Michael. Big
not
Mac
at all. No. No, we're fans to be sure.
Yeah.
But it is an issue that we're hearing more and more from companies, and I think it's a question of at what point do we see consumer wallets are essentially tapped. Despite the headwinds and the concerns that I just mentioned, the market's really not showing it. If you look at valuation multiples, in this case, we're looking at the PE ratio of the S&P going back the last 12 months. I mean, we're not at record highs, but we're certainly not in what I'd call, cheap territory either. We're on the higher side of historic averages. And particularly if you look at the Shiller PE ratio, which looks back 10 years and has been predictive. If you look at the previous spikes right before the Great Depression, right before the tech bubble burst, I mean, it has been a not flawless, but does have some precedence of predicting market tops. And so I think when you see these elevated valuations, what you can infer from that is that market participants really believe that publicly traded companies, in this instance, companies that make up the S&P 500, will continue to see earnings growth despite all those headwinds that I just mentioned, which are many. So Austin, I'll pass it to you, but just to recap, we have geopolitical tensions, we have GDP growth slowing, we have inflation rising, we have certainly dour consumers possibly seeing their wallets getting tapped out by this inflation spike. And despite all that, stocks aren't cheap. So what say you?
And you just ran over my dog. I mean, whether you got everything's terrible. No, I'm just joking, Michael. No, I think it's important to articulate all those things, and it begs the question then: should we stay invested? A little inside baseball here. We both were involved in that first setup of things, and we're both involved in this setup of things, which is to say our answer is emphatically yes. Why? The first reason is that, look, the markets are at highs because the expectations for future growth are high, and we actually expect that growth to happen. And that is largely because of the conditions that are set up currently. We'll give you these sets of conditions. The first is on net, monetary and fiscal policy are accommodative. Now, we could argue about monetary policy. Is the Fed's rates low enough to produce growth? But when you add that in or net that with fiscal policy, which is massive deficit spending, so spending far more than the receipts that we receive, in part to fund the war, but in large part, many other ways, that is accommodative on net, those two things on net. Bond yields, again, these have gone up, and it's a little bit, I may have even added it to your list, Michael, of things that may be a little bit concerning as we see kind of some yields going up. But default rates are low, and in the aggregate, as we compare over history, they're actually pretty darn low. So those things are supportive of growth, earnings growth, economic growth, CapEx and investment in our core economy. Not only are they at relatively high levels, they're at increasing levels. And this is not just data center investment, although the investment in data centers and physical infrastructure are a large part of the growth and the acceleration. But we're seeing growth really across the economy in terms of CapEx and investment back into people's businesses, which again is also supportive of growth. Similarly, productivity levels are very high, and we're seeing them increase. So productivity is really just the unit of production that we get or the economic growth we get per unit of work. And so since we've had a labor force that's been it's growing a little bit, but an economy that's growing faster, we're seeing more productivity. Again, that is the stickiest part of economic growth, and also conducive and supportive of better stock prices as well. And then finally, despite all those things that you pointed out, the economy keeps chugging along. Earnings keep chugging along. And I'll go into that a little more of that in detail. But gosh, we are in an environment that when you stack all these things together, and we'll come back and talk about some of the concerns to offset these, on net and on balance, we think it's a market that is supportive of going higher and owning the right types of productive assets. Going into that EPS growth, you'll see that we've kind of had close to not record, but certainly 5-year high in terms of overall EPS growth. You can see the Mag 7 really had a lot of EPS growth on the chart on the left, whereas the others, it was more muted, but it was certainly north of 15%, which is fantastic year over year earnings growth. The positive earnings surprises, most, as we know, most companies set a level here, a low benchmark, so they can clear that hurdle. But even above 80% of companies beating is a historically very strong level. We've also seen guidance pretty strong, which is also important. That's not on here, but we're seeing some earnings expectations, not only for the quarter be strong, but analysts are upping their earnings expectations for the balance of the year, also supportive of a stronger asset prices. Here's another one we like talking about. We don't like talking about it, but it's an important thing to point. It is very painful to not be invested in the market and sit in cash. Why? Well, the purchasing power of the dollar is just down and to the right, as you can see on the right. And part of that is that as government debt goes up and we have no political will to get a balanced budget, the way to make your past debts more palatable in the future is to debase and devalue your currency. Unfortunately, that is happening. That's happening with money printing and inflation. So to defend our purchasing power, in order to defend your way of life, to make sure your kids and grandkids live as well or better than you, you need to own productive assets. Before we get started on how we're going to do that, I do want to flag a couple of concerns. And this is kind of the balance of me saying invest everything. Look, AI is a huge and pervasive factor in the market. If the return on an investment or the productivity gains or the net job growth that is expected from this innovation, if those fall short, or if any one of those, or worse, if all three of them fall short, this market will tap out. If we have low and middle income consumers tap out the way that certainly some of them have at restaurants like McDonald's, but certainly not in the aggregate, that's an issue. If we have geopolitical tensions that escalate in Iran or elsewhere, then of course the unforeseen black swan events could impact this market. So what we are trying to do is find a way to both grow assets and protect them at the same time. And I alluded to this before, but the way to do that to start is to play offense. Your best defense, the way to defend your purchasing power, is to play offense, or in other words, own productive assets. We like to think of one of the best productive assets, Michael, as those world-class businesses that are capable of compounding their earnings at a very high rate for a very long period of time, and therefore being able to compound your wealth at that same high rate for a long period of time. This is an example of a company that both you and I like very much, that we think is a productive asset. CRH is the world's largest building materials company. They sell aggregate, cement, asphalt. If there's a large mega construction project out there, chances are CRH is either involved in it or wanted to be involved in it. They are a large company. They're actually large internationally as well, but the United States is their largest business. They have done a great job of producing shareholder return for owners of the company. You can see that on the 5-year total stock return. We talk about shareholder yield, Michael. I know that's one of your favorite topics. That's when we think about, as an owner of the company, what did we receive? And so you can receive that in the form of dividends, but you could also receive that in the form of owning more of the business. And so we think about that as if CRH were to retire shares, such that if we own 1,000 shares and there were 10,000 out there, and so that means we own 10% of the company. If they bought back half the shares in the outright, then we would own 20% of the company. So they're just a great producer of value for us. Still trades at a material discount to many of its peers. You know, our Martin Marietta or Vulcan Materials are examples of peers. Michael, I think when we were looking at this business initially, this was kind of the sum total of why we liked it. We thought there's some great infrastructure that needed to be built in the U.S. and abroad. And then this would be a great benefactor of that, as they were well-run, great capital allocators. But recently, with this surge in data centers, growth and reindustrialization, CRH is starting to talk about this, and they are uniquely positioned, we believe, to capture some of this growth and benefit from it.
100%. When people think of data centers, think of things like chips and needing electricity, but they require a lot of rocks too. And CRH on their last earnings call highlighted that, and they're working with several data center projects, but just one in Michigan last quarter, they delivered 1.2 million tons of aggregate to, which is, you talk about these numbers, they're kind of like, what does that really mean? That weighs as much as 3 Empire State Buildings. That's just one data center. So the need for what they do across all the data centers that are going up is absolutely huge.
Yeah, no, absolutely right. This is an incredible set of assets that they've built over the past 5 decades, including 20 billions of reserves and aggregates, which we talk about gold and reserves, but increasingly the aggregate reserves is a really valuable thing, and it's a localized business. So you want to work with who's nearby you. You can provide a better price. That's what they do across the country. This is a chart that Brookfield put together, but I think it just shows that while AI and the hyperscalers are sort of dominating the headlines, it's really the infrastructure to support AI that is being built out over time here. And just think about all these different types of industries that are adjacent. CRH touches every one of these. And so it's example of a business that we like. It's a productive asset, an enduring business that we think will be very strong over the coming decades, as recent, and we are favorable and optimistic on it over the next 6 months as well. I want to point out, though, we're not, in this case, cherry picking a winner. CRH has not worked in 2026. And frankly, nor have many other highly historically resilient, world-class businesses with high returns on investment, and we think, frankly, are well-run. These are in many foxhole areas that we like long-term. Advantage payment networks like American Express or Visa, best-of-breed P&C insurers, financial exchanges that essentially operate a monopoly, like the New York Stock Exchange or oil and gas and futures and commodities exchanges, the like. Even these market-leading high return on investment restaurants. What I think is important to point out in this current market is every one of these companies has increased their earnings this year, and on average, well north of the S&P 500 earnings growth that we're seeing. And yet, every one of these companies is down on the year. The underperformance is more than 20% relative to the market. So I would say that, my point for flagging this is twofold. One, markets do not always move in sync with earnings. And the markets now are trying to figure out, are these businesses going to be as resilient and world-class and capital efficient in the next 10 years as they had in the last 20. We think yes, but the market's still trying to figure that out. But the other piece of this is, I think, and this is the point that I'd like to really hammer home. We have a very narrow market leadership right now, where semiconductor businesses, memory and storage businesses, those have really dominated the market and driven returns. That needs to broaden out, and in order for the market to maintain strength. And the analogy that we talk about these are picks and shovels plays for the AI revolution. But if these companies, these world-class companies, ultimately don't generate a strong return on investment from all that spending on AI, in other words, if there's no gold to be found, the picks and shovels, you can't sell as many of those. I think that you and I are both optimistic on that for many winners. There will be losers as well. But I just point out that we expect the market to broaden, not necessarily in a straight line, but these types of businesses that have historically been great should do better in the coming months and years. What do you think about that?
I think that's right. There's a certain segment or limited segments of the market that are sort of having a moment right now. I think it is something to see, and some of that we do have exposure to, but obviously you don't want, all your chips in just one hot basket. So there's a lot of world-class companies that, we were just talking about it earlier today. There's some companies that traditionally trade at much higher valuations suddenly are out of favor. And so there's seemingly some deals out there.
Yeah. And I'll point out, we have one strategy that owns the vast majority of these and in size, our forever strategy. There's other types of things like permanent portfolio strategy that are similar. That's really challenged right now, but our outlook and we believe these are strong businesses. Doesn't mean we don't own some other things like NVIDIA that are doing well. We expect the market will need to broaden in order to continue to stay strong. And we do think that'll happen. Cool. So how do we grow and protect? We need to own those productive assets, but security selection matters. So we started talking about that. We want to own those companies that are benefiting from AI, not threatened by AI. You and I will talk a little bit more in detail later about what that means. You talked about the K-shaped economy. Look, you don't want to fight the tide. And so those businesses that are more focused on high income consumers are ones that we're gravitating towards. If you're in an environment where we have a weak dollar and potentially considerable inflation, you need to be able to take price be a price maker or have pricing power, and not be someone that people tell you what your price of your good you'll sell it at. So we're looking at those companies that have pricing power. Again, we want to be administration friendly versus antagonistic, and we want to own those high quality businesses that are enduring franchises over the long term. A little more on that. We'd like to own the industry leaders with healthy margins, with strong balance sheets, strong returns on investment, and well-run that have good capital allocators. These are good in all environments, Michael, but you and I have talked recently that when you get into tough environments, when there are some players that go out of business, interestingly enough, these high quality businesses can take more share. They can actually, on a relative basis, improve their business more during the tough periods and then come out even stronger on the other side.
Absolutely. It's almost like a springboard. They chug along fine when the economy is great. When it's not so great, that tends to be when they grab share. You might see a little bit of a deceleration for a bit, but then they come out stronger on the other side.
Yep, totally. So with that, maybe I hand this over to you.
Sure, absolutely. So another factor that we really look for when we're making up an entire portfolio and strategy is diversification. As we kind of hinted at, there's some hot areas of the market right now. We want to own some of that to be sure, but we think it makes a lot of sense to invest across the market and be truly diversified. That is not what some people associate with diversification. Some folks think, if you invest in different countries or own a few different sectors, that works. But the reality is, even if something, two securities seem like they'd be a lot different, they can move pretty similarly, depending on how they react to different risk factors. So when we're talking about diversification, yeah, we care about, where a company is domiciled, where they operate, what sector and industry is it, but we also take a look at risk factors. And to give one example of that in interest rates, if you were to look at the financial sector, there are banks in that sector, there's property and casualty insurers. Depending on the direction of short rates, that can be if they're increasing, that could be a negative for banks. It can be a positive for P&C insurers because they tend to put their float that they get from customers in those short-term instruments. So higher yields mean they're making more money, whereas it increases the cost of capital for banks. So, seemingly similar companies because they're in the same sector group, but react quite a bit different. So we want to be mindful of these risk factors. Moving on to the next slide, and kind of going the next step with that, I want to talk a bit about correlation, which simply means how do two securities tend to move relative to each other. This matters quite a bit, and 2022 is the example that we'll share with you. Austin kind of pointed to 2022 earlier in a year that we managed to hold on to assets and actually grow them a bit. Why does that matter? Well, if you remember what happened in 2022, I'll paint the picture. Inflation was spiking. The Fed was cranking up interest rates to try to combat it. Folks were scared that those high rates would send us into a recession. Stocks started collapsing. And what a lot of folks thought would happen is, well, stocks are going down, my bonds should go up. That didn't happen at all. Why? Because again, rates are rising, and simple bond math is rates are going up, the price of those bonds are going to go down. In other words, their correlation was quite high. They were moving together. So you have two asset classes, stocks and bonds, you'd think would give you some protection. One's going up, the other should go down, right? Not in all instances. So correlation is something that we're very mindful of in addition to that diversification that I mentioned. So what do you do to lower correlation? Correlation is a changing number, but there are assets that tend to have a lower correlation that we like to invest in. One is merger arbitrage, which simply means in a merger arbitrage situation, there's a company that is going to be acquired. An announcement has been made, a price has been announced. We know what it's going to be acquired for, but it hasn't been bought yet. And there is a spread or a difference between what the company is going to be bought for and what it's trading at today. And so the spread between those two is your return, assuming that deal closes. Not all of these are great deals, but it is an area that we like to look for and have done really well in the past. We like the low correlation aspect of this because they tend to march to the beat of their own drum. They aren't zigging and zagging along with the market because all of a sudden the return for the deal is predicated on if that deal closes. It really doesn't matter what the heck the market's doing in any given day, week, or month. And you can see that in this chart, what we're looking at, those blue lines, and all of these are days when the S&P dropped at least 1% over the past 5 years. So blue line is S&P. The orange line is a basket of merger arbitrage deals. So you can see that when that blue line is dropping, the orange line right next to it tends to not drop nearly as much, but there's even quite a few days when those merger arbitrage deals were positive when the market was down over 1%. So this is a great example of an investment that not only can we get a nice return, but we lower that correlation to the overall market, makes portfolios less volatile, smooths out the ride over time. Another area that we like quite a bit is gold. And this is showing gold over the past couple years, ending at the end of the last calendar year. It's given a bit back since then, but we think that the long-term drivers for gold, frankly, are still there. When you think about central banks being quite evident in their attempts to get away from dollar exposure and increasing their gold exposure, thinking of geopolitical tensions that are still there, thinking of, if you recall the chart that Austin showed of debt levels going up, value of dollars going down, we think that long-term drivers for gold are very much still in place. And in addition to that, it's been a nice hedge in various volatile markets. We'll take a look at three instances here in which the S&P 500 is going to be the blue line, spot gold price is the other line, and you'll see whether it's the tech bust, the great financial crisis, or more recently during the COVID crash, it has certainly done what gold's supposed to do, which is preserve its value in times when the market around it is experiencing heightened volatility. Anyone that's been investing in gold for a while knows that we do tend to have these big spikes like we've seen the last few years, and then that's often followed by periods of not much activity or even giving some of it back. And so this is just one factor in a number of factors we look at to try to determine what sort of environment are we in when it comes to investing in gold, because there's more than one way to do it. And we actually have a gold-focused strategy in which we do invest in physical metals, but we also look to major production miners. We look at emerging producers, which is anywhere from companies on the cusp of becoming the majors to smaller single asset type miners to literally pounds in the ground type companies that maybe aren't operational yet, but have tremendous stores of gold in mines that aren't yet operating. And then royalty companies is long-term, one of our favorites as well, highly capital inefficient. These are companies that are essentially financing mining operations in exchange typically for a part of the gold that is produced. So depending on what sort of environment we're in, these different categories can all do relatively better or less great. So we actively manage this strategy to capitalize on that.
Michael, what I would say is I agree with all that. Of course, if I were playing the role of a client or future client asking, why hasn't gold worked this year? And do we think that, gold should and gold related investments will do better in the future?
Yeah, I would point to a couple things this year. One, particularly around the time of the conflict, there was one notable central bank that actually started selling their holdings because they were worried about supporting the currency. And so there was that. But I think, bigger picture, I showed you the 2-year chart there, more than doubling in price. I think for a lot of folks, they took that volatility as a time to realize some gains, to lighten their exposure a bit. Makes sense. If something's had that sort of a run up, folks will be inclined to take some chips off the table. So I don't view the bit of a pullback that, it's roughly flat for the year. We're not talking about a huge correction, but slowing down in momentum, to be sure, seems pretty natural to me.
I think it's right. And I guess what I was at is exactly what we believe is that, look, it actually became a bit of a momentum investment for a bit. And now, we see it as, continuing to be the core part of your portfolio as a chaos hedge, a diversifier, and a lower correlation asset. But the conditions are there for it to be a strong performer over time. So we still think it's a suitable and attractive part of a person's portfolio. Don't want to be overweight gold. In fact, we cautioned many clients at the beginning of the year that it enjoyed 100% plus gains in the gold strategy to, if it had become too large a portion of their portfolio, let's make sure we have it as a diversifier, but not the the only thing in our portfolio. But I think the conditions, especially with central banks and fiat currency debasement, central banks demand and fiat currency debasement, conditions are favorable for going forward. Let's talk a little bit about just how to invest in this age of AI. I think to set the stage, obviously, this is all coming about because there is a huge surge in spending. These are some numbers that, frankly, have, I think, become obsolete. The Gartner expected that there'd be about $2 trillion spent on AI this year. When you include services, software, the hardware, and the CapEx, that actually might end up being low, particularly as Alphabet and other folks have continued to increase their expectations. Similarly, FactSet just produced these expectations recently in last month in May. And yet I think even these on a cumulative basis might be a little shy for 26 and 27. We're just seeing it could be north of $1 trillion of spending for these four hyperscalers. And if you add in what OpenAI, Anthropic, and XAI are doing, we're north of $1 trillion just for a few companies. And so, the question then is, what do we do with this? Well, we need to, we're early, it's a little early. And so we need to see what type of impacts it's going to have on real world companies. Will we see an ability to increase productivity and increase opportunities to monetize some of the intelligence aspects that we're getting from this technology? Michael, you and I are utilizing it daily and weekly in our businesses. We talk with management teams that are utilizing it. I think the key for the economy will be, does it produce, again, more output per person employed? And will it on net, while there'll be disruptions, will there on net allow for the same or more people to be employed?
I think for the first one, I could say emphatically yes. I have gone from the last year or so kind of being a skeptic to just having AI as a hugely supportive part of my day in all sorts of aspects, researching companies, pulling up data. It's become kind of an integral part of the workday and beyond. So the efficiency part, I have very little doubt.
Right, and I think the quadrillion-dollar question, I guess, is the second piece, which is, will it lead to net employment and economic growth? I think it will, but there will be lots of disruptions along the way, and we want to embrace those areas of productivity and growth and avoid the disruption. So, we've kind of put together these pillars for us, which is sort of mission critical. And we think that others should follow this in terms of how they invest in AI. The first is, let's lean into those durable winners, own those businesses that we see already benefiting from AI adoption. The hyperscalers or the NVIDIA, or maybe the folks that are helping to build the data centers or the memory, that's the most obvious play. We kind of like some of those. We'll talk a little bit about that, but need to make sure that we own some of those winners. So long as, and especially if we believe that that's durable winning and productivity and profit gains. Part two of this is, you've heard people have talked about, it's not just what you own, it's what you don't own or what you avoid. And we want to make sure we avoid those things that are structurally impaired or highly vulnerable on the long term, not just short-term sentiment, but long-term. And then finally, we want to target those businesses that are resilient. Maybe they own hard to replicate assets. Maybe It's not clear that they'll benefit from AI right now, but we think long-term they will. That is the type of thing we're thinking about, sort of bucketing our investments and avoidance into those three things. I'll hit the first two and then you can hit the third, Michael.
Deal.
We want to own these durable winners. And these are some of the kind of attributes we're looking for. Is their core business turbocharged by broader use of AI? So I'll hit these and then I'll talk about two examples of two companies we're talking about. Competitive moats. We love businesses that are durable, that really have something that it's hard for someone else to replicate. And is there expanded use of their ecosystem or platform? Are there scale advantages or adoption of AI that actually increases their competitive moat? We want to see a business that's taking advantage of these demand tailwinds. Hyperscalers investing in something, sovereign AI, AI adopted on an enterprise or larger scale. And then finally, we want to see indications of financial strength emanating from this investment in AI, accelerating revenue growth, strong margins, strong advantage balance sheets, and in some cases, accelerating cash flows. That last one is where I want to point out. We believe that a business like Google or Alphabet is an example of all of these, except for the accelerating cash flows. An example of one that is every one of these is NVIDIA, where it's one of the few businesses that is increasing its free cash flow as so many companies invest in this AI proliferation. The hyperscalers and then many others along the value chain are not seeing increases in free cash because they are the ones doing the heavy investing. Again, that will prove out, but even Jensen Huang himself is pointed out that this is the largest infrastructure expansion in human history. And importantly, it is accelerating at extraordinary speed. We saw this recently from Alphabet that talked about investing kind of $31 billion in CapEx 1 year, last year growing to more than 90 billion, and already guiding to more than 180 billion for 2026 and considerably higher in 2027. Just incredible increase in investment. Now, to what company's detriment? Well, we do want to exit those businesses that we think are highly vulnerable. Yes, certain types of software are included in that, where we see that there are more competition from software that can be easily and readily created through use of things like Claude or other types of AI engines that are capable of iterating and continuing to create software at a very high clip. So as we look at it, there are certain human resource functions, even some customer relationship management functions that could be automated. Now, that's not to say that if you're using Salesforce right now, you'll stop being a client. In fact, Michael, we are not going to some off-the-shelf or vibe-coded offering versus the Salesforce that we do employ currently. It does, though, to that next bullet, provide challenges where will we pay as much for that upgrade, or will the next customer decide to go and spend a lot on Salesforce or some other HR tool? And here's the question that we're asking ourselves for a lot of these businesses that we think are vulnerable. The data that your business, that this software business runs on and is dependent on, is it your customers' data or is it your own proprietary data? And ultimately, if a technology business does not have control over or have its own proprietary data, and it's really just kind of reshaping or reorganizing some customer's own data, we think that is highly vulnerable. Any comments or thoughts there?
No, I think that's right. We aren't of the opinion that a lot of these, particularly SaaS companies that have been under pressure, are necessarily going away. Thinking specifically of highly regulated businesses like our own, there's some value in having trusted vendors with strong track records instead of vibe coding,
Yeah.
And we aren't alone in that. There's a lot of companies that are in the same boat, but it does introduce the potential for more competition and the margin compression that comes with that.
Yeah. Now, targeting resiliency, that's all you.
Thank you. I mean, Austin's been highlighting the sort of disruption that is possible. Opportunity, yes, but also disruption. And so part of how we tackle this is trying to determine what businesses are likely to be resilient in the face of all this. And then if there's an AI upside to go along with it, even better. And one of the areas that we have been looking at for that is entertainment, which we think that, that's hard for, an AI chatbot to replicate. People are going to want real world experiences. So these bullets, I had a particular company in mind, which is Vici, a real estate investment trust. They have different entertainment assets, but primarily known as a player in gaming and casinos. They have, you mentioned earlier, Austin, trophy assets. I mean, they have some absolutely irreplaceable trophy assets on the Las Vegas Strip, like the Venetian and MGM Grand. Talked earlier about inflation. One of the things I like about this company and others, they aren't the only gaming REIT out there, but a lot of their long-term leases that they have with tenants are linked to inflation. So if inflation goes up, their rent goes up right along with it. And the AI upside, look, we think that it's definitely possible that this leads to increased leisure time and simply a demand for more real world experiences as we're all just increasingly reliant on technology and things get digitized. I think it's natural to want a real experience away from screens. And so you certainly get that in Las Vegas and other areas of entertainment that we're also looking at on the resiliency front.
Absolutely.
There's kind of a fourth pillar, if you will. For the first three we talked about were definitely AI specific. But I think whether you're talking about AI or frankly any other type of market, there's value in being nimble and flexible because things change. And a strategy that we have that's really focused on doing just that is our tactical select strategy. So we wanted to touch on this one as well. The way that we go about this strategy is first we take investment ideas that we already love across all of our strategies. We've already done the fundamental analysis, some of which Austin mentioned, all the things that we look for. Is it a high quality business, strong management, and so on. In addition to that, we overlay several quantitative measures to sort of narrow down the list, if you will. Some of these are platforms that I'm sure some folks on the webinar will be familiar with in Tradesmith and Shaken Analytics. Others are our proprietary tools that we use, but we want to identify a lot of different quantitative metrics that we find value in to really get the strongest names that we can into this strategy. And the end result, you get names that fundamentally we love, that are momentum and quantitatively favorable as well. And this has been a strategy that we've ran for over 3 years now, and there's been a lot of changes in 3 years. It seems like it's I don't know, the last 3 years has been like over a decade in terms of market events, where it was having so much going on, rate changes, geopolitical conflicts, tariffs, you name it. And the strategy has done just what we would hope in being nimble and changing as the market changes. Some of those quantitative factors we list out here, there's frankly quite a bit more, but we wanted to at least touch on some of them. A big one, and I know important to a lot of folks we talk about, is trailing stops. Not an arbitrary number, though. We adjust this for volatility. Simply put, some we want on a shorter leash, and some stocks we expect will have more up and down to them when we want to let them run. But we absolutely have volatility adjusted trailing stops in this strategy. Look at things like concentration, volatility, momentum. One I wanted to point out, though, because I think it's frankly can be overlooked, but we've seen a lot of predictive value in it, is earnings revisions, and so that's one that we pay attention to, and it was one of the factors that encouraged us to actually exit a position that we're grateful that we did, and that's in Fiserv. Not a household name for everybody, but within financial services, it may be. This is a company that does payments and technology solutions for companies in the financial services industry. Been a winner for a long time, and it frankly had done well for us. But we started to see some signs that were concerning, including the earnings revisions that I just mentioned. Ultimately, it was in our tactical select strategy, but we opted to exit. You could see where, it dropped over 70% after we sold it. So, not saying that it's perfectly predictive in all ups and downs, but frankly, it has done well in exiting a lot of positions before we saw much more substantial drops, like in this case. And I think investors are understandably inclined to think about upside returns, but the other side of the coin, just as important, is avoiding those big drawdowns in companies like that. Results speak for themselves. You can see the numbers versus the benchmark over the past 3 years. On an annualized basis, and over that period, outperforming by a pretty large number. Less volatility as measured by beta and drawdown alpha, suggesting that those returns are not just market exposure, but influenced by management decisions like security selection and timing. So, Austin, I mean, you and I work a lot on this. We did a ton of back testing before even launching it, and I don't know if there's anything you'd add, but I think it's been really notable how it's performed in a lot of market environments.
Yeah, no, I think that's right. It continues to perform well, maybe less well this year than others, but continues to generate strong alpha. And I think the key part is the drawdowns are lower than the overall market. That's really what you want to do. You want to avoid those big drawdowns. So if you look at the beta, that's the volatility. So it's 3/4 of the volatility of the market, but you do actually want upside volatility. You want your earnings to go up, or your performance to be upwardly volatile. So I look at max drawdown and say, gosh, it was only roughly 40% of the market's drawdown. That is important to still be able to produce strong positive returns, but mute those periods of weakness when the market was weak. I think our point, though, is we've said this before. Our investment philosophy is. We want to make sure you are prepared. We don't want to necessarily predict exactly what's going to happen, but we're going to make sure that you're prepared for anything that the market throws at us, but then also anything that life throws at you. And so we like to think through and be an asset, an ally, as you think through what are your investment and your life goals. And if those goals are different from another investor, then ought you not invest in a different manner than that other investor? So, at a high level, we like to say that every investor has just 3 goals. They want to maintain their wealth or protect their capital. They want to generate sturdy current income, or they want to grow their wealth. Or, of course, they could have some balanced view on all those things. And so we as a firm invest along those goals. And so if you look at these strategies, they may do many different things, but their primary focus is one of those buckets. Also, we know that every client is a little bit different in terms of their risk profile. So if we look at the maintain wealth, for example, our short-term U.S. Treasury strategy is very, very low risk. We are not investing in those long-term treasuries that think people say that they're low risk, but they may not be in different interest rate environments. But you're not going to generate a great return in that. So really what is important to us is that we understand kind of where your goals are, what your tolerance for risk is, but really that it fits into the entire holistic approach of your financial planning. We know we have clients on the call that have taken great advantage and to their great benefit, having calls and extended portfolio reviews with our wealth managers, our skilled wealth managers. And if you haven't done that yet, we encourage you to do that. It really just sets up, frankly, it allows Michael and I to do our job better if people are positioned in the right sets of investments. And then, in turn, we just think that the whole thing works better when you are positioned the right way. So I'd like to say that for existing clients, please make sure you reach out to your wealth manager. I think we're pretty special in the sense that you have the ability to work with Michael and my team and get some world-class investment management. But at the same time, you have another dedicated team doing world-class wealth management for you as well. And so if you're not yet a client, please reach out to us and we can help with a complimentary portfolio review and kind of go through some of those things. Join our team. We think we are a winning team. This is the whole team that got together in Texas recently. And we're having fun, but part of that fun that we're having is knowing that we're having a positive impact on all of your lives. So we appreciate that. It's a great honor and privilege to do that. If you have an interest in joining our team, just click here. And if you're already part of our team, Michael and I just want to thank you very much for that endorsement. Any final thoughts, Michael, or things that you want to talk to folks about?
Yeah, quickly, just seeing that picture, I joined this firm in 2017. So we've been doing this over 10 years now. I've been here for the vast majority of it. And it's been really neat to see the size of the team grow, but not just growth for growth's sake, but really like offering more and more for our clients, more capabilities, more resources. So thrilled with that. Also that review that Austin mentioned, for folks that aren't yet clients, would highly recommend taking advantage of that. You get a good idea for how we do things, how we view things. And, maybe you find that we're an optimal fit, maybe you don't. But frankly, I have spoken with a lot of people that have gone through that process and have never heard that it's been a poor use of time. Like whether you become a client or not, it's always been enlightening for them and learned something that they hadn't thought of before. So highly encourage that.
I agree 100%. Just to recap in very short order here, we think the conditions are set up for markets to continue to power higher in spite of some of the risks that are out there. But given those risks, we think folks need to invest prudently to make sure that they're optimizing the opportunities to grow their capital without putting it too much at risk and making sure they're protecting capital. So how do we do that? We own productive assets. Security selection matters quite a bit. We want to make sure that we have a lower correlation and true diversification across our portfolios and what we own. We want to embrace AI and invest in AI in the right way. Avoid those things that are definitively AI roadkill, if you will. And finally, we want to be nimble and tactical with our investing to make sure, investing is seasonal. You don't have to be set in one type of portfolio forever. So we want to make sure we're nimble and tactical. And then putting it all together, work with your wealth manager, even if it's not us, to make sure that what you own is right for you.
I think that's it. Well said.
All right. With that, thank you everyone for tuning in. Please reach out to us. We love our interactions with you, and we'll talk to you soon.
Thanks, everyone.